Thank you very much indeed, ladies and gentlemen. It's a great pleasure to be here. Very propitious day, actually, 26th of June. Very propitious day in cinema history. And bear with me on this one a little bit, but I wonder if anyone can tell me what very famous film premiered on this day a few years ago. And of its type, it was the 5th highest grossing film of all time. And it's to do with gold mining. I'll make it a little bit more interesting. There's a bottle of champagne, if anyone can give me the right answer. Anyone want to take a wild guess which film was premiered on this day a few years ago? What? Gold? It's a good guess, but it's not the right one. No, I'll give you a hint. In this classic comedy, the star heads north to join the Klondike Gold Rush. Trapped in a small cabin by a blizzard, he is forced to share close quarters with a successful prospector. It's pretty unlikely already. You know that this is fiction. And a fugitive. Eventually able to leave the cabin, he falls for a lovely barmaid, who's played by Georgia Hale, trying valiantly to win her affections. When the prospector needs help locating his claim, it appears the star's fortunes have changed. Anyone? It's not gold. Anyone want to take another? No? All right. I'll tell you. It's the Gold Rush. You almost got your bottle of champagne. It's the Gold Rush. It starred Charlie Chaplin. It cemented his status as in the iconic role of the Little Tramp. It featured, amongst other things, the dance of the dinner rolls, where he's waiting for his girlfriend to come up, his girlfriend who we don't know, and he sticks 2 forks in the rolls and he starts dancing with them. And also the meal of the boiled shoe leather. I think we all know how that feels, probably, if you're in the junior mining industry. It was his last movie before the talkies. And it was the film for which he always wanted to be remembered. So that's what happened on this day in 1926. And that hopefully segues me nicely into the subject of Greenfields versus Goldfields. And to do this, I've invoked my favorite junior mining company, which is a gold mining company. It's non-such gold. It's a gold company that doesn't exist. And that's why it's very easy to talk about it. And to do an analysis of it. I say it doesn't exist, however, it is a conflation of all the junior miners out there. And something that we do at Edison every year, and you can read all about it in this report we stick out once a year. And if you don't get your hands on a hard copy, you can get your hands on a soft copy. Just go to our website and it's there. It's a pre-MiFID II publication, so you don't need to pay for it. And something we do every year is we look at what is the average value. You've got this concept of dollars per ounce in the ground, which we use a lot in gold mining companies. And we say, all right, but you can distinguish between the different sorts of ounces, whether by category, whether they're measured, whether they're indicated, whether they're inferred. And these are the figures we get. And in the case of gold, we block it down by our market. So we've got the London market, we've got the Canadian market, we've got the Australian market. And we also do exactly the same thing to work out in this row here, what we think it costs to discover these ounces. So immediately we can start comparing costs with values we get in the ground. And I'm going to talk about Greenfields. This first section is about Greenfields, and then we'll go on to the Brownfields later. And we can immediately get an idea about where value is created within the mining industry. And for the various markets here, this is what their respective graphs look like. So what I'm looking at here is I'm saying, all right, we've got a company with cash at the beginning, and it's got about $1,500 of cash. And in year 1, it's going to drill up a resource of 100 inferred ounces. In year 2, it's going to convert some of that into indicated and inferred. In year 3, it's going to be measured, indicated, and inferred, and there's going to be no cash. What is the value of that company worth? And that's what these lines show. And what you can see is if you're in London or Canada, you get a little bit of kick at the inferred stage, but then really nothing thereafter. Australia will give you value at the indicated and inferred stage, the indicated and measured stage. So already you can get an idea of the sorts of points in the evolution of a mining company where you can generate value or where you can see investment returns as an investor. Now, if I put that together, we collect all these benchmarks, and what we always do is we always make the sample size as big as we possibly can. So what I'm showing you here is the various discount rates for companies at different stages of development. And what we've done is we said, all right, let's change the value we get by changing the discount rate, and we'll make the value equal the share price, and then what we'll look at is the discount rate. So in number 1 here, this is all companies which are at PEA or scoping study. This is the range of discount rates we see. Number 2, that's pre-feasibility. Number 3, that's bankable. And then it goes on like this. Number 4 is finance. Number 5 is in developed. And number 6 and number 7, they're both in production. So now we have discount rates that we use, variable discount rates for different companies at different stages of valuation. And then we can say, all right, we can put all of these things together and we can create this company non-such gold. And what we'll do is we'll make it the junior that everyone wants to create. So what you're going to do is you're going to find 1 million and a bit ounces to begin with. They're all going to be, well, you're going to raise money to begin with. Then you're going to find 1 million and a bit ounces, then initially in the inferred category, then in the indicated and inferred category, then in the measured indicated and inferred category. Then you're going to do a scoping study. Now, all your studies are going to say the same thing, but we're going to apply different discount rates to them. You're going to do 100,000 ounces a year. You're going to do it over 10 years. It's going to cost you 100 million to build. You're going to make a margin of $600 an ounce on all the ounces you mine. At the end of the life of the mine, you're going to reprocess what you've got in stocks, and you're going to get a little bit of working capital out of that. It's going to cost you 100 million to build, and you're going to finance that 50-50 debt equity. And when you do all that, what does non-such gold look like? And this then is a share price. No, it's not a share price. It's the valuation of the company at every single stage of its life. Right from you raise your initial money over here in year 0. That's inferred year 1, indicated inferred year 2, measured indicated inferred year 3. Year 4 is scoping. Year 5 is pre-feasibility. Year 6 is bankable. Year 7, you finance it. Year 8, you're spending CapEx. Year 9, you're spending in CapEx and ramping up. 10 is first year of full production. And then you're paying off debt. At this point, you paid off debt, and then you're getting the declining life of mine forever afterwards. The mine actually finishes at the end of year 18, and then you get that last bit of value out at the end of year 19. That is what the valuation of the company looks like. And as I say, it's all market derived, so this should be a conflation of all the juniors in our sample, which is several hundred companies. Now, we can also move that to the share price because we've predefined everything. This is what the share price of this said company would look like. It would start at 1 because I started it at 1. I said that's where you're initially raising $1 for $1 at par. And then as we see it, as it goes through the exploration stage, on average, you're going to be losing money, right down to the point where you do a scoping study. And then it's going to pull back for pre-feasibility and bankable. You're going to lose money again when you finance it. I bet we've all had that feeling before. And then you're getting this going into production and over the top, and that's what it looks like. Now, so we're also beginning to get an idea of where we can make money. These are returns you can expect to see from this strategy. And you can see in the first, probably easiest to look at these light gray lines here. You can see in the first 4 years, you're probably going to get negative returns. You're going to get 2 big positive returns for your studies. That's as you go from scoping to pre-feasibility to bankable. You're going to lose money in financing, and then you're going to make money again as you go into as you go into development and you go into production. Once you're in production, actually your returns are pretty boring from the perspective of the shareholder. These are total returns, by the way, so it's both income and it's capital, but they're almost the lowest you're going to get. And then you're going to get this little kick here. This is as you wind up your working capital and you put your low-grade stockpiles through the mill at virtually no cost. But in percentage terms, you're getting an extremely good return. So we're getting some ideas where, within the context of Greenfields, where you can make money already and where there are danger points, where there are things to look for. It becomes even more interesting, I think it becomes even more interesting, when you look at, so that is non-such, that big green line down the middle. This is the maximum value you can get, so the lowest possible discount rates and the highest possible in-situ values. And what you notice is that this spike here, which corresponds to the maximum value we found for inferred resources, it's a lot higher than it is for the average. And so you can get this possible spike here. We've all seen that. I mean, you can think of companies like SolGold, for example, where they've been putting out these drilling results, even way before they even got to the point where they were announcing a resource. They were putting out results and they were getting valuations in the hundreds of millions of dollars. So that $200 million, remember, that is a maximum, but it is something that is achievable, and it is a point where you can get sort of preternatural returns. That was a gold company. Not all companies are like that. This shows you enterprise value per ton, so resource multiple here against resource size down here. And what you immediately notice, and the reason I picked this, and this is for graphite companies, graphite explorers, is you have a very strong and statistically significant inverse correlation between your resource size and your resource multiple. So what do I think is going on here? What I think is happening is that is the market saying for some metals and minerals, and they're not all the same, for some metals and minerals, we will give you credit in advance for what we think you're going to discover, not what we think you're going to have. Doesn't work for all metals and minerals. It doesn't work for gold, for example, and certainly not in the London and Canadian markets. It might just, in the Australian market, you might get credit for a bigger resource, not in London and Canada. Graphite, yes, you will get it. Zinc, you'll get credit for a large resource as well. Again, chapter and verse is in this report here. So I'll leave you to look at that if you want, download it. Anyway, there are lots of bells and whistles. There are lots of combinations and permutations. These are just some of the areas. So whenever I'm talking to a company which is in one of these particular metals, like graphite, and they've got a small resource, I always say, shoot, iron ore is another one. Shoot all the geophysics you possibly can and all the surveys and all the aeromag you can. Because if you can give the market the impression that you have got a lot more of this resource than you actually have stated, they will give you credit for it. There is statistical evidence that they will give you credit for it. This is one of my favorite share prices, the share price graphs. Sirius Resources, I'm sure you all know Sirius Resources. But it shows some of the pitfalls and some of the benefits of what I'm saying. Now, you may, for those of you who don't know the story about Sirius Resources, share price was down to about 6 cents. They were down to their last $1 million. They were in a tent in the Fraser Range in Australia. They were looking for nickel, and they were pretty much down to their last. They weren't taking calls because all the calls on their mobile phones were coming from creditors. And of course, they pulled out the most spectacular nickel call that everyone's seen for the last 100 years. And this is what the share price reaction is. Now, what's the danger of this? The danger of this is the shares went up 46 times from 6 cents to $2.70, $2.80, something like that. And the danger with this, what happened, is for the rest, from this point here, from 2000 and whatever we are, 2012, right the way through to 2015, the share price averaged what it hit 10 weeks, just 10 weeks after that hole. So if you didn't get into these shares within the first 10 weeks of that hole, on average, you made zero money. You made zero return. All right, you've got a bit of, you could trade that. You could buy it at 2, and you could sell it at 4, and you could trade it. But on average, if you bought and held, and you got in at that point there, you would have made nothing between there and there. In fact, you may even have lost money. And why is that significant is because this company was fantastically successful. Between here and here, they did more drilling. They announced a resource. They found another resource, which is this spike here. They then did a study on it. They did a scoping study. They did a pre-feasibility. They did a bankable study. They put it into production successfully. And right at the end here, they sold the company. In all of that time, you wouldn't have made any money at all. So that's why when I'm talking about Greenfields, you need to be very, very aware of where value is to be exploited as an investor and where it isn't and what to look out for. Because this is a great company. But for all but these 10 weeks, I would say it was a lousy investment. This report here, for the very first time we've ever done this, we did a long study of how values are affected by various qualities of a project. And so we're looking at EV values, and we're looking at discounts, and we're comparing them to internal rates of return, grades, jurisdictions, and sizes. And we're seeing what conclusions can you draw from these. This is the first conclusion. And this is just looking at IRRs for companies at different stages of development. And what you notice is that for companies at PEA stage, they're very overrepresented for projects which have IRRs between 40 and 60%. That's pulled back at the pre-feasibility stage, where they're overrepresented at the 20 to 30% IRR level. And my rationalization for that is because all these should really be the same height. These are sort of roughly the same height. But just looking at these here, what's my rationalization? Well, studies that have an IRR at PEA stage of between sort of 40 and 60% are likely to be pegged back to 20 to 30% when you get your external consultants doing your PFS. And then they're likely to come back out again at bankable stage into the 30-40 rate. But that's what you're looking at. You're looking at a project with an IRR to begin with at PEA stage 40 to 60 will probably be pegged back to 20 to 30, and then you might get out to 30 to 40 when you do a bankable feasibility study. As I say, all this is on average. How does that affect valuations? Well, you might have thought that a percentage on your IRR would give you a bit extra valuation. It appears that way if you look out here, but if you look out here, if you look at this peak here, very high IRRs are not represented by high valuations or as high valuations. However, you do see these much higher valuations in the 0 to 10 and 10 to 20% range. So that the natural conclusion is that you have a fairly average project with an IRR of 20 to 30%, you may well have a valuation in the range of 0 to 20% of EV or share price divided by NPV or of the project. So the discount to NPV you're looking at might be between 80 and 90%. If you do the actual correlation between IRR here and valuation here, it's a pretty poor valuation. It's a pretty poor correlation at this stage, just 0.2% and certainly not statistically significant. But I'll come back to that in a moment. Part of the reason is you see that there's this huge range. Now this is IRRs and this is a frequency. So number one is companies at PEA stage, and you get this range of IRRs. Number two is at pre-feasibility, you get this range. Number three is bankable, and you get this range. But if you look at the valuations, you're getting this range. You're getting a much wider range. But then look how it's pegged back at pre-feasibility stage. You're not getting the range at all that you're getting at either at the PEA stage or you're getting at the bankable stage. This is what the actual probability density distribution of these things looks like. And what you had to be very careful is this is quite logical in the sense that at PEA, you'll probably be at 0 to 10% of project NPV. At pre-feasibility study stage, you'll probably be between 20 and 30. And when you're at bankable, you'll probably be out here somewhere. But be very careful of the averages, because this is a very, very skewed distribution. And these have a disproportionate effect. When you see people value according to an average, you're putting yourself in a lot of danger. You want to be very aware of where the average is, the mean, and how that relates to the mode, because your modal valuations are nowhere near your mean valuations when you're looking at valuations. This is where we put together our two. This is non-such. That's the maximum there, that dark green line, and the average is that grey line, and the bottom end of the range is the light green line. And then these dashed lines are where we do exactly the same company, and we just value it in a different way. We do a discount to NPV. And what you can see is if you use discount rates, you get a smooth and logical progression upwards. But when you're doing this discount to NPV, you're getting this contraction in value at the PFS stage. So you need to be very, very careful of that. I said we'd come back to this valuation, this regression analysis. If you look at this regression analysis just as it is, you would say there's no relationship at all between IRR and a project IRR and a company valuation. That's not quite true. If you break it down by the type of study you're at, there is a very, very strong correlation at PEA stage, a much weaker one at pre-feasibility stage, and a much weaker correlation at bankable feasibility stage. When I first did this, I thought, well, that's because all of these are in different jurisdictions. And that, Burkina Faso, for example, that is, as you go in valuation, as you go down from the top, that's the first African project, see? And when you're coming in downwards on the IRR axis, that's the first African. So I said, all right, these projects are in African countries and everyone's giving them a huge discount. So let's have a look at the correlation between valuation and the Fraser Institute Index of Investment Attractiveness. Now, that's the correlation you get. That, as it stands, is not statistically significant. But if I knock out that point there, when this is not strictly a mining company in the sense that everybody expects it to be, then you will get a statistically significant correlation. What does that mean? Well, this is the correlation with grade, and that's very, very strong. So if you put these together, what are the most important things? What confers value on a company? Well, at PEA stage, definitely grade, definitely IRR. Not at all jurisdiction. The market doesn't care where it is. And actually size might be a problem for you. That actually might detract from the valuation. Could be too big for your company in the eyes of the market. As you go to pre-feasibility stage, still very strong on grade. Strong, statistically significant on the IRR level. Jurisdiction, market still doesn't care. Size is still detracts. As you get to bankable, however, you'll see it changes quite a lot. Grade comes down. Jurisdiction goes up. And it might go up even higher. It could go up to there and be statistically significant. But what you notice about these is when I sum them here, you would expect them to sum at about 1. So what this says is you can describe the valuation of a junior company at PEA stage and PFS stage purely in terms of grade and IRR. But once you get to bankable stage, that's not good enough. It's grade, it's IRR, it's size, it's jurisdiction, but there's something else as well. Now, I don't know what that is in truth, but I suspect very strongly that it's management. So you've got to look at all these three things. To begin with, it's all about grade and IRR, and latterly, it's about everything. So another conclusion, these are all my conclusions then on Greenfield's investments. Exceptional returns are possible for converting cash into inferred resources. You don't always get them, but you can get them. SolGold will show you serious resources. Beware, though, of what you get afterwards, because it might be discounting absolutely everything for the rest of the life of the mine. Best years to invest, well, when you're going to scoping study to pre-feasibility, pre-feasibility to bankable, financing to development, and development to production. Worst years to invest, exploration to scoping study, and the year before financing. I think we probably know that. Beware of for well-valued and averagely valued companies, beware of the pre-feasibility study valuation trough. You might get a much better valuation study. You might get a much better valuation at PEA stage than you will at pre-feasibility stage. The Australian market will give you credit for size in gold and also the measured category of resources. Canada and London will not. There is evidence of size discounting for other metals and minerals like graphite. Have a look at the report. As I say, it's free. It'll tell you where you can get those discounts and where you can't. Different metals and minerals have different investment characteristics. We know that. What confers value on a mining company? Well, at scoping study and pre-feasibility study stage, it's grade and IRR, but definitely not size. At bankable, it's everything plus probably management. That is Greenfield's conclusions. I'm going to be very quick on Brownfields because I'm aware of the fact I'm out of time. So let's just define what we're talking about when we talk about Brownfields. We're talking about a mine or a company or a project that is already being developed, and we decide we decide to expand it. And in this case, what I said is I've taken non-such, and I said we can expand it two ways. We could either drill up another 100,000 ounces of reserve, and we could add it to the end of the life of the mine. And in that case, what you're going to get is you're going to get not this grey line, which is non-such as itself, but you're going to get this green line here. And that's going to cost you about $1 million to do. And what is the uptick in valuation you're going to get? And of course, the biggest uptick you're going to get is in the second last year of production, when you're basically expanding the mine life by not from 1 year to 2 years, and that's where you're going to get the greatest uptick. The other possibility is you could expand the project itself. So if you were right at the beginning with 10 years to go, you could add 10,000 ounces a year for 10 years. If you had 9 years to go, you could add 11 and a bit thousand ounces a year. Or if you had 8 years, you could do 12,500 ounces a year, like that. So let's compare these two things. How does that make the non-such? Now, the non-such line is this, effectively this line here. And as you see, as you expand it, you get this valuation kick for all the various different scenarios. I know that's not a very easy chart to look at, but what we're doing is expanding the plant. In the last case, you're literally expanding the plant by 100% in the last year of production. So instead of producing 100,000 years in the last year, year 18, you're producing 200,000 ounces. That is always going to be a value killer, but I put it there for the sake of continuity. Now, if we look at the valuation uplift relative to that line, that blue line, this is what the chart looks like. So that's non-such down the x-axis there. That is if you expand by 10% or 10,000 ounces over the remainder of the life of the mine. That is if you expand by 11,100 ounces. So 10 years to go, 9 years, 8 years, 7 years, 6 years. And against all of that, that is the valuation uplift if you expand the mine life by 1 year. So you add an extra year on. Now, how do we analyze those? You can either get a larger uplift at the end in terms of dollars, but you're getting at the end of the life, rather than a smaller uplift if you expand it just by 10% over the entire life of the mine. So what is the best value? Well, if you do a discounting analysis, and I know this isn't very easy to look at, but what you can see is where this is the expansion here, where it crosses these lines here. And what you can see is if you expand by 10% for 10 years, 11 and a bit % for 9 years, 12.5% for 8 years, 14% for 7 years, and 17% for 6 years, they will all give you better valuations than expanding the life of the mine by 1 year. So you want to expand the plant rather than extend the life of the mine. For 6, 5, 4, 3, and 2, you're going to get less value. So There's one qualification I'd make to that. If you look at it in percentage terms, you will see that you can also, if you want a percentage uplift, you can still expand the mine by 20%, or expand the project by 20% over 5 years, or 25% over 4 years, or indeed 33% for the last 3 remaining years of life. Now, why is that important? Because it depends on how your management and your stakeholders are incentivized. The most value, then, we can conclude when we're looking at brownfields companies, the most value is added by increasing the project size early. You want to expand your plant by 10%. Instead of producing 100,000 ounces a year, you produce 110,000 ounces for 10 years. In fact, with more than in the case of non-such, with 5 or more years of life to go, you expand the project rather than you extend the life. But the greatest share price reaction will be increasing the project size by 33% with 3 years remaining. If your management is therefore then incentivized relative to the share price rather than relative to value, they may be very keen to do these larger expansions of the plant later rather than which is not economically rational, if I can use those words, but they may be incentivized to do that. So you have to be very careful with your incentivization. We probably all know this, with 1 or 2 years remaining, you always extend the life of the mine. It is always going to be value destroying to expand the plant by 100% for 1 year or by 50% for 2 years. That doesn't work. I'm not going to go into this now, but that is a very erudite little academic study into why, all other things being equal, there is an immutable law of mathematics which is going to be inclined to pull any discount to NPV towards a 70–80% level. It's in the report if you want to have a look at it. I'm conscious of the fact I'm out of time. Carol, thank you for letting me run over. I know I did there. I don't know, are there any questions? No. I'll take that as a good sign, I think. Thank you very much indeed.